Happy Cinco de Mayo, everyone. This is Joe Gordon from Gordon Asset Management, and this is our weekly update today. You'll see the first slide here is just some disclosures. I'm not going to bore you and read all these, just basically indicating that we are an SEC regulated and registered investment advisor, and we are not giving investment or other advice on this call for today. So basically, we're going to now look at this transition as some of the states in our country get back to work or open up. Can we stimulate our way out of the crisis? Also, before we start, you can sign up for updates on our website at wealthqb.com. So basically, as we've done in the past, a quick review of the coronavirus cases. Obviously, most people know all this information, over a million one cases in the U.S. It seems like things are flattening out. However, the U.S. now has more cases than the Spain, Italy, France, UK, Germany, and Russia combined, which probably isn't any surprise. If you look at the effects of the shutdown on the markets and how the market cratered there beginning in late February on into mid-March, you saw over a 30% decline. But we have had a snapback rally. The third bullet, you can see the S&P closed up April 13%, the best monthly performance in over 3 decades. So there was a snapback rally. A lot of people are skeptical that it's going to continue. There's just too many unknowns that have to play out with the reopening of the economy. Overall, the S&P was basically a little bit lower for the second straight week last week, and so that has us all wondering if the best has already passed. If you look at also by sectors last week, one of the things you'll see in this graph is that the best sector year to date, the light blue line, is technology, just barely down year to date. And if you just look at the 6 big tech stocks, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, they're actually positive as a group. On average, healthcare has been right there with tech, only down 4% year to date. And then energy, although it's been the worst sector year to date, down almost 40% because of the OPEC plus deal, production cuts, and the dead cat bounce, as some call it, energy prices off historic lows. It was the best sector last week. So when you look at volatility, the fear gauge, as people call the VIX index many times, you can see it's tapered off from a high of 85 on March 16th all the way down to 35. But you have to also consider that in fairly secular bull market, normal times, it's still 3 times elevated over where it is today or where it is normally. So we're concerned about that, but it seems like the trend's reversed and it is down more than 50%. So basically, if you look at fixed income, you can also see that year to date, the Barclays Ag, which is intermediate bonds, mostly treasuries, is flat year to date. Quality has trumped credit, and high yield's been the worst performing sector. It is worth noting again that the Fed is stepping up to the window and has been buying credit throughout all sectors, including high yield. Also, long duration investments have performed, but it's really been treasuries that have had double-digit returns as people fled to safety. So now let's look at what's going on in the economy. So jobless claims have reached a record high. Some estimate it'll peak at 16%. We're now over 30 million unemployed claims in the last 6 weeks, 3.8 million the week of April 20th. And you can see here in the graph how it has spiked up even from the 2008 levels. It really is at record highs. Haven't seen this in a long time. The CBO expects unemployment to surge to 14, some say 16, who knows? And then basically, the Wall Street Journal says, I think we have passed our peak in claims, and the claims, new filings weekly, are trending down. One other way to look at this is cumulative employment gains over the last 23 years have essentially been wiped out in this last 6 weeks of shutting down the economy. So here's the big problem. If about 70–75%, according to whose estimates you look at, of our GDP is the consumer, what is the consumer doing? You can see here consumer spending dropped significantly since March, down 7.5% month over month. It's down the most since 1959 of any one month. And basically, the U.S. consumer spending, credit card spending, is down 25% year over year. So this is how the stay-at-home lifestyle is reflected in the numbers, and the numbers don't look good. Normally, you will see a recession in the near, not too distant future with numbers like that. If you turn to manufacturing, you can also see uh, data coming in, sharp deterioration of the U.S. economy, with the ISM index down to 41.5 over here. You can see where it's been in prior cycles. It dipped way below that in 2008. So we're not even all the way there yet. Who knows? We may be heading that way. But actually, the contraction is typical of a recession, and that doesn't bode well. And then you got your economic recovery indicator, which is a number of factors in an index: mortgage apps, jobless claims, high yield bond spreads, and other things. And again, we've had this slide in here each of the last few weeks. It is still trending down at its historic low, and 6 of the last 7 recessions, dating back to '67, have been preceded by this going negative. And since it's at its negative lowest reading in history, that's fairly ominous as well. Then we look at GDP year over year change, and you can see here at the bottom far right, it's declining by just under 5%. If you go back to the left and look at that graph, you can see what happened in 2008, 2009. As far year over year change, here we are at the tiny 0.3, but headed in the negative direction, just like in 08, 09. A lot of people are concerned about going back to work. We had this slide the last couple of weeks. People, almost 50% are saying if stay-at-home orders are lifted, they're not going to go to public places until the outbreak's over. And basically, then 63% of Americans are worried about restrictions being lifted too fast and worsening the outbreak. And some say that they may not go back to work. So we'll have to see what happens as the non-essential orders are lifted and things get going in the economy. And you've got Texas as the lead state, probably, and then you've got Tennessee, Georgia, South Carolina, and even Florida, and certain spots opening. So here we go to the stimulus, or the liquidity injection by the Fed and Treasury. On the left, you can see all the aid passed in March. You can see the April 24th, the additional $484 billion, $310 billion of which replenished the Paycheck Protection Program. And then you can also see in the graph to the right is just the comparative of the TARP stimulus versus in red what we're doing now, versus the blue is the financial crisis of 07, 08, 09. So considerably more spending. And so the real question is, can we stimulate our way out of a crisis? And that's going to be a question that has to play out. Nobody knows. There is just no precedent for this amount of stimulus. You can see public debt on the left slide approaching 23 trillion. And then you can see the graph on the right is basically as a percentage of GDP. We're at 105%. This slide basically is looking at the balance sheet of the Fed, and the key point is that it's at its all-time high, 9.3 trillion, nearly double the prior record. And again, that's no surprise because they decided to help everyone this time, not just the banks and the mortgage servicing companies back in the financial crisis of 08. So essentially, you see the various programs there. We'll see how it plays out. But where do we go from there? And here's a couple closing points in today's presentation, is that if small business, which is the majority of the employers in the country, if 80% are reporting slower sales, and 31% are even having supply chain interruptions. And then you've got reports concerning sick employees. That doesn't bode well. You also have to recall that, and this was a study actually done in 2019, but in a Federal Reserve survey, 40% of households have less than $400 in savings. So if you lose your job, you have to get unemployment pretty fast, or you're going to be defaulting on credit card payments, utilities, and other things. In Wampley's survey, 55% of small businesses estimated would not survive a 3-month shutdown. You can just get the visual of restaurants in your local area and wonder how they're going to survive. And so here's the 6-week totals now over 30 million, as I mentioned earlier, essentially racing 23 years of employment gains. So if 1 in 5 Americans who otherwise would be employed are out of work, how do we have an economy that starts expanding? I mean, we're at ground zero, we're restarting it. Usually it looks recessionary, and things are just going to have to play out. One other real question that a lot of us have that no one knows the answer to is, once all the liquidity is injected in the system, and take the Paycheck Protection Program, and 8 weeks of salaries are funded, then what? What if the business isn't there? I mean, how do restaurants seat people at full capacity like they used to because of the spacing requirements? These things have to be answered, and they will be. But given all that, not to be negative or depressing, but about data, but it isn't positive. It's unprecedented. There are things that we like. There are quality investments, both in equities and debt. Treasuries have been a safe haven. There are companies with fortress balance sheets. Essentially, there are companies that have been flourishing. Think not restaurants, think grocery stores. But then also there's the digital economy, the online e-commerce, have things shipped to your home, work from home, video conferencing, those kind of themes. 5G is still expanding. There were a lot of names there that we like, both in REITs and communications companies. And then you've got inflation hedges, and then consumer staples. I mentioned grocers. You also have companies in healthcare as well. And then there are some bargains. And when we say bargains, things on sale, we're not talking high beta bets on cruise industries or even the airlines industry, which many saw over the weekend at Warren Buffett's annual meeting. He's sold everything he owned in the 4 major airlines. He just thinks the business model has got to be rebuilt. And I heard yesterday that the Miami Dolphins, for example, have configured out how they can play games with fans, and they can only seat 25% of the normal attendance that they normally had. If their stadium seats 60,000, so they said they can accommodate 15,000. I'm not sure how you make money doing that. But anyway, there are good companies on sale, and we think that energy has definitely hit a bottom. Whoever thought they'd see the spot price go negative? But there was a supply problem as far as the economy of the world shutting down. And then there became a demand problem. Nobody was traveling anywhere. So there are some bottom fishing opportunities that we do think are going to play out well, especially energy, once things normalize a little bit and we get to $40 to $50 a barrel oil. So with that in mind, that's the conclusion for today's comments and this week's comments. If you want additional information, if you're a client of the firm, please feel free to contact any of us, either through the website or our emails you probably have. If you're interested in learning more about our firm and you're not a client, please feel free to reach out and we will contact you right away. Thank you. Have a good day.